Well, hello everyone. My name is Karandeep Sodi, and I would like to welcome all of you to today's Graphite Financials workshop on how to build a financial model. This workshop will be led by Paul Bianco, CEO of Graphite Financial and former VC at FFVC, who will share his insights on building pro financial model for VC-backed startups that not only wows investors, but also helps you run your business more effectively. We greatly appreciate the overwhelming support to this workshop. And now, to give a brief overview of Graphite Financial, I would like to invite Josh Leider, Manager of Business Development at Graphite Financial. Josh, over to you.
Hey everyone, how's it going? I'm just gonna share my screen here, and we'll get started. Okay. So Graphite Financial, I guess I'm here to give an intro on Graphite, but I'm also going to tell you the story about how I got involved with Graphite, which I think is relevant to the story. I'm a past founder. I had a small meditation company before this, and then a wellness company before that, before I got involved with Graphite. And for both of those companies, I managed all our accounting and finance, all of our bookkeeping, all of my modeling, all of my taxes, and it was a huge time suck. As a founder, I should have been spending my time on many other things, and it actually held me back from a bigger acquisition in my last company. And so when I shut down that past company, somehow got connected to Paul at Graphite, really fell in love with what they were doing, and the rest is history. Now I work on growth and business development for Paul and his team. And Graphite, in a nutshell, is an accounting department as a service for early stage startups. As you can see, we work with many large and small startups in the ecosystem. But the really unique piece about the company is that we were born out of a venture fund called FFVC, where Paul used to be a VC. And the fund at the time was offering small value add services. There was some marketing help, PR help, and then finance and accounting was this very small value add service they were just offering their portfolio companies. As time went on, more and more portfolio companies asked for that service and wanted that service, and the service grew and grew and grew until 2016, when Graphite broke off to become what is now Graphite. I think we were about 3 or 4 people then. We're about 45 now. And again, we act as the outsourced or fractional accounting department specifically for early stage startups. That looks like many different things, but we have 3 main services we offer. And our beefiest one is our controller services. That's where we actually act as your accounting department. You get staffed with a dedicated team. A big difference between what we do and other companies, other outsourced accounting firms do, is that most other outsourced or fractional accounting firms are more volume-based. Their teams are working with 15, 20, 30 clients at a time. We're the opposite side of the spectrum. You get a very bespoke team. They're only working with a handful of clients at a time. They're very dedicated to you and actually learn your business model so they can provide strategic advice along with the accounting support. We also do a lot of financial modeling and CFO support for our companies, helping them build out financial models. We can sit in and act as their fractional CFO to kind of help them steer the ship and plan for growth. We offer tax services as well to all of our accounting clients. We're very, very focused on technology and infrastructure, helping you build out scalable and proper infrastructure that will work with you as you grow from 5, 10, 15, 100 employees, and just setting the things in place to make your life a lot easier as a founder and as an operator. And then, yeah, the last thing I like to say is there's a lot of value in working with a fractional firm. You get a lot of heads at the table, a lot of experience. Graphite is just a kind of a hodgepodge of founders, investors, VCs, accountants. But another perk of it is that it tends to be a much more efficient route as well. You don't pay a fractional firm for vacation time, downtime, benefits, etc. You're only paying for what you need. So it ends up being very efficient for startups as well, which is usually important when you're a bootstrapped growing startup. And yeah, if anyone is interested or needs accounting support from Graphite, whether it's accounting, CFO support, financial modeling, we'll send a follow-up after this. Just ping us. We're very unsalesy. We're very consultative in nature, and we're always happy to talk to a new startup and hear about what you're working on. But with all that being said, I'm going to turn it over to Paul and get this started. He's going to lead us all through a really, really awesome financial modeling workshop.
Awesome. Thanks a lot, Josh and Karandeep, for kicking this thing off. And thanks everyone for joining. So I think, Josh, I by me sharing my screen, I kick off your screen. So give me a second here.
Yes,
So
I believe so.
yeah, so I'm really excited to have the opportunity to do this talk about financial models. So like Josh said, we spun out of a venture fund. I was an investor there. And really kind of Graphite, the genesis of Graphite, actually, it didn't really start with the accounting. We were doing a lot of financial modeling work for our portfolio companies. That's when I really began to realize that it's really not an Excel exercise. I think a lot of companies treat it as an Excel exercise. It really is a strategic part of your business. So it's also really financial modeling. We've worked with so many companies, and the fun part about it is it's really one of the only times you could take 100 steps back and just think about all things about your business and put it all on paper. What is all these things combined, what do you think is actually going to happen with the company? So it's a great time. You start digging into we're doing stuff, but are these things working? Are they not? Are they working so well we should double down in certain areas? So that's what we're going to cover today. So a couple things. So our website is graphitefinancial.com. We do have a financial model template on our website, but we actually just created a special one just for this. So for everyone in attendance, after this, we're going to send you a link to a Google Drive, no strings attached or anything, just kind of a cool thing so I'm going to go through that with you guys and do a live demo, like 5 minutes or something, just to show you kind of how it works. But be on the lookout for that afterwards. Don't bother with the one on we're going to be going through a separate one than the one that's currently on our website. So this is really what I want to talk through. Really two main things. One is what I call the modeler's dilemma. And this could be the founder is often the person doing the model too at the beginning. If the model is too simple, even if you hit plan, there's no way of knowing why you did. Or if you didn't, no way of knowing why you didn't. So it's important to kind of figure out that right balance there. And then on the other hand, if it's too complex, I mean, these things get ridiculous, like impossible to maintain. You don't know what's going on. You have to almost audit the model, and that's not good. And then the founder's dilemma, and this may be one and the same person as the modeler. And I get this question a lot. Now, if a company, if you project things, especially if you're raising money and your projections are too conservative, does this look, people say, Paul, does this look like a lifestyle business? Am I not going to be able to raise VC money because of it? Usually my response is like, well, what do you think you could actually do? Like, forget about what the VCs care about. Like, let's think about what's real first. And then the other side of the coin is, and I've seen this, too aggressive and it looks ridiculous. Early on, as in my career in VC, a company was raising kind of, call it their seed, not even two or like seed 5 bridge, whatever. And that's fine, right? Companies, it's never up and to the right. You raise bridges, this, that, whatever it is. But in this one case, the company was going to go from 0 revenue to like GDP basically within 3 years. And it was faster than any company in history has ever grown. And it's like, okay, to kind of, I think it's worse to present something so crazy that's bigger than even your market than to present something that you really think is going to happen. So we'll talk about these things, and then also how it relates to raising money, managing your board, and then really just planning the business. So I'll start really high level, and then again, we're going to get to the point where we're actually going through a model during this session. So just taking 10 steps back, what is a model? And I've even thought a lot about this because it's not just what you think is going to happen. It is, and it's not your source of truth, but it is an aggregation of a bunch of different things. Maybe you have QuickBooks or Xero, that's the accounting actually source of truth. And also there's also non-financial KPIs that maybe live in another system or your Gusto or TriNet or whatever, your employee counts, but it's an aggregation of all those things, financial and non-financial, that's both happened and that you think is going to happen all together. It can't be one or the other. It can't just be projections with nothing from the past, because then as a reader, as a user of the model, it's hard to understand, well, how realistic is this based on what's happened before? Again, the output is going to show you what your financials looked like and what they will look like all together. And I usually recommend, for companies building a model now, I usually recommend at least adding all of 2020 in there. Even though 2020 was a weird year and like good and bad for some companies, depending on the industry, it's worth at least putting just that year in, if not 2019 as well. I don't think if you started in 2010, I don't think you have to put everything in there. It becomes ridiculous to manage. But that's generally what we recommend. And then really at the end of the day, and this is personally how I use a financial model, the output and the assumptions it really should tell you what you need to do next. You know, if I want this to happen, what do I actually have to do to make it happen? I think too often numbers are kind of just put in there, and it's really just, you can't just, well, some, you know, you could try to will things into existence, and founders definitely do, and I certainly have too, but really there's a lot to making your numbers happen. So and also just level setting this, what we're actually talking about here, because there is confusion oftentimes when we're doing these. So we're not talking about doing a valuation model, it's an operating model. I wouldn't, especially if you're early, I wouldn't really use your model as a way to, we've had companies try to kind of take their model, then do kind of a discounted cash flow analysis and try to value their company based on that. This doesn't make sense at the seed stage or even or at a certain point, the numbers begin to make sense when there's product market fit, but it's really just a way to run your business, understand what's going to happen. Now, I'd say the number one reason companies come to us to help them build their model is because an investor is asking for it, or a board member or something like that. But really, it's something you should use not every day, right? You don't have to you should be talking to customers, building product, not every single day, but you should be using this to help measure and kind of run your business, understand what's going to happen. Again, it's not an Excel exercise, though you build it in Excel, but it really should be an exercise in understanding your business. It should have both a P&L, balance sheet, and cash flow. You don't have to be a finance and accounting expert. Our template that we're going to share with you guys for free after this, we'll just have that built in. You don't have to do anything there. It should not be 40 tabs. It should be as simple as you could make it. And then without being too simple. And again, it should map to your real life accounting. And yes, it is a spreadsheet, though the same way that Carta dominated kind of Excel cap tables. I do think that's going to end up happening here. I think there's just a lot more nuance and complexity here building financial models for companies, because there's so many edge cases versus a cap table. But I do think that will end up happening. So I'll go through a couple lessons basically. So lesson one is to keep it simple. Now, I guarantee these are, I mean, maybe not real quotes that companies have said to me, but like slight exaggerations of what has happened before. And basically they Frankenstein if they get too complicated, and you kind of add in layers of complexity upon layers of complexity, assumptions on top of assumptions. And then you end up with like almost being to the point where you have to audit your own model, and you don't remember how things are flowing or how it works. Too many formulas, trying to get too fancy with Excel. Again, you need the Excel to work, but if you can't understand what the formulas are doing, it's a problem, obviously, because if the person building it can't even remember, then no user, no VC, even an analyst or a really great analyst at a VC fund is going to be like, I don't know what this formula is trying to do here. I'd say the other biggest thing is, there could be so many versions. So best practice that I like to do is, so like this one up here, like, didn't we hard code these in version 72 final draft? Like that's kind of real that I've seen. And anytime we send a model out to someone, like let's say the board, take a copy of that one, set it aside in a folder, call it, literally I call it, version 3, version that we presented to the board of directors on this date, period. It's now memorialized, it's separate. So keep them aside or you'll never remember, or one that you sent to a potential investor. You build a kind of your budget technically once per year, but then you reforecast, but you're changing the model all the time. So you're going to have so many versions. Just be careful about which ones are which and who saw what. And so that's important. So in terms of complexity, only model what you can measure in real life. To build a model, there's a bunch of assumptions that you have to make. And that's normal and you have to, it's part of it. But if there are assumptions that you put in there that you don't have your however you run your business, your kind of systems of record, your however, if there isn't a way to eventually see if those assumptions, how real those assumptions are, because they're so complex or difficult to measure, you shouldn't go down that route. So for example, for a SaaS company, and I'm going to talk a lot about SaaS and then kind of direct to consumer and e-commerce, just because that's a lot of our clients fall in those two buckets. For a SaaS company, at a minimum, you should really be able to measure sales rep productivity, churn / retention, which is the kind of the opposite of churn, kind of upsell, basic things like that, just to understand, what we're going to go into unit economics, but kind of understand lifetime value, customer acquisition costs, and things like that. That's the bare minimum that you need to be able to measure. And for e-commerce, pretty similar. You have to be able to measure CAC by channel. It's difficult. Attributing channels is notoriously difficult due to the nature of how consumers shop. But you have to have some kind of methodology to attribute, flow it through into the model, and then try to understand what the kind of reorder rates and re-engagement is, so you understand lifetime value there. So this is one of the number one things. I see this a lot. I used to see this a lot. I see it less now, but this to me is not a model. It's something, it's numbers on paper, but this is the market size is, every market is $1 zillion, of course, when you're starting a company, and kind of just put years in there and then just say, well, if we just get capture a tiniest bit of the market, look at what this business will be. Well, this is what we call top-down model. It doesn't show you how you're going to go from 0 to 1 at all. And it's this tiny, tiny, tiny fraction of a percent. Seems easy, but you really have to build it up logically in how you build it. So, and the model, again, the template that we're going to share with you does that automatically, so that's easy. For a SaaS company, for example, what the output I'd like to see is, especially on the revenue side, one is, so this all the way to the left, this revenue projection. Personally, again, I used to be a VC, but also work with a lot of SaaS companies now. Show me your revenue projection. How much of what you're projecting in 2021 is from existing customers? That's the bottom. Layer on top, how much is from your pipeline? And that gets complicated because it's usually not the estimation of likelihood of close. It's that we find companies are usually too optimistic about when the company will be sold, closed, and onboarded and actually generating revenue, because there are significant lags between those things. So that, and then your pipeline has a horizon of a few months or whatever. It depends on your business. But then you're going to project stuff that's after your pipeline, things that will eventually enter your pipeline in the future. But layering it like this, you could say, okay, this blue, that's real. This red is pretty real, but now this green, that's looking, is this going to happen? That's a pretty high ramp up. Is that magic? How is that actually going to happen? So segmenting it, and then, again, this is in our template automatic too. So segmenting makes it a little bit easier. Now so the biggest part of building a model is everything from revenue all the way through revenue and cost of goods. And we could talk about what those are, through gross profit, and then how you get there. So generally sales and marketing. That's the biggest piece, but most companies are very, very similar across the board otherwise. So, every company has payroll. Every company spends some amount on marketing. Every company has some kind of technology, SaaS products that, add up and absolutely kill you. Rent, maybe not now, with a lot of companies going remote, but some kind of physical space, travel, meals, these things are pretty universal. So the good news is projecting this stuff isn't that hard to do. It's just it's a function of just sitting down, thinking about it, really planning at least a year ahead. So this stuff you could just do during a couple working sessions with different department heads, or if you're a small company, just the CEO comes up with these numbers, or founders. It's the revenue side again. So sales and marketing, whether or not it's direct, like sales rep, sales reps driven. If you're B2B, or if it's more of kind of a paid advertising or whatever it may be, you have to be really thoughtful. That's where the unit economics really come into play, and that's why. And if you get that wrong, the whole model is basically tells you nothing. So, so the good news is, it really 80% of the model is basically you could do very, very quickly. The rest you have to spend a lot of time on. Now, I'm going to do a very quick tangent on unit economics before diving in. So the way we build our models, again, there's some driver to how revenue is happening. And so I've seen, and here's an example for a SaaS company, the way at a minimum, what you should look at for, either on a per sales rep basis or all of them aggregated together, how much have you spent, because it takes time for a sales rep to ramp up, start contributing. How much have you spent on this person, cumulatively, and how much gross profit, not revenue, how much gross profit have they generated cumulatively over time? And you'd be surprised when we do this analysis with companies, how many are like this 24-month horizon and it's like not even close. And so it's like, what is the payback period? Like a decade? That usually means you either don't have product market fit, or something's wrong. So you don't want to be this company. You want to be this company. And by the way, when we've seen this happen before, where companies are, where it's not crossing over, and that value isn't being derived above and beyond the customer acquisition cost. And usually it just means a little bit of a pivot on how you go to market. And I've seen a company go from this to, not a unicorn yet, but I think they will be, because they changed the way they were selling. If they continued down this road, they would have been turning $1 into 50 cents, just at scale. And maybe no one would have noticed either until eventually someone would have. And then on the consumer side, retention's really everything, or reorder, depending on what type of business you are. So I'm just showing two examples here, two different retention curves. So the good one is the yellow one, and this is showing how much revenue is derived from the subset of customers that joined in a given month. And so, yeah, you could tell that the yellow one is way better than the blue one. But to show you what that means money-wise, so this was the blue one, the bad one. It takes 24 months to catch up there. Now the other one here is actually this. So it makes that much of a difference. So literally everything in this piece between the, after they cross, is pure incremental profit to the business that you could reinvest in growing the business, or sit on piles of cash, or however you want to manage your excess cash flow coming in. But it's crazy how much of a difference retention makes. So paying attention to that as you build the model, but also just generally part of the business. So I just want to go in a little bit of a tangent there. And then in terms of CAC and LTV and other unit economics, we prefer these charts, because when companies are showing their CAC LTV ratios, it's always some weird different sort of formula, and it's like never universal. So just showing payback over a period of time is way easier. I personally, for me to grasp, maybe I'm more visual, but I think it just tells you more. It shows you the payback and then just how much incremental profit you make on top. Just be careful when you're doing that and presenting it in your decks. Lesson 2 is to know your numbers. And models are based on assumptions, right? So you just need to know those and be able to defend them through a diligence process. Very easy at the angel stage, right? No one's really gonna ask you anything, to be honest. Seed, depending on the fund, it'll be a little bit more intensive. And then once you're at the A and B stages, you really and it's kind of more growth capital, you really, really need to know these numbers inside and out. So it's important, even if you're the founder, you're not the finance person, you should at least know, you don't need to know everything. You don't need to be an accountant. You don't need to be a CPA, CFA, whatever it is, but you need to know what makes the business tick and be able to speak to those things. And so it's funny how things have changed. And I started in VC in 2013. And this was something I heard on a panel like a talk like this, right? And it's true. Financial models are usually wrong, but again, you want to know why they're wrong. But what I've seen change is just I've seen an increased focus, especially at the stages where companies have achieved the product, kind of product market fit, and it's more growth capital. It's like a scene from The Accountant. Like VCs are really diving deeper. Maybe it's anecdotal, but personally, I've noticed they're diving deeper into the numbers, really wanting to understand unit economics and what makes companies tick. And then again, as it relates, I'll just touch on this super briefly. VCs will ask for a model. I'd be surprised if they don't. Make sure that your model ties to the numbers in your deck, and you'd be shocked how many times it doesn't. It needs to be like one. Again, it's your record of truth. Use the model as the main thing. Don't do off to the side calculations that now don't tie, and it adds questions, and then people start wondering if you're just making numbers up. And the other thing I'd say is at early stages, sloppy finances overall, I've noticed has generally been a proxy for sloppy execution generally. And the reason is it's just when important things are put to the side, it tends to be a turnoff. Not every investor, but for some. I'd say unit economics are under a lot of scrutiny now. I think there's just more of a general understanding in the VC ecosystem as it grows and matures about what the numbers are, what they mean, even at earlier stages. Just let's at least talk through what this thing is going to look like. And again, poor unit economics usually means poor product market fit. It's just not there yet, and that's okay. Once you hit product market fit, it's kind of a science at that point, and just not just a math game, but like you can kind of figure out what the business will look like. But again, so if you start seeing that as you build your model, you look at your historical numbers, maybe the pricing needs to be different. If you're not kind of paying back on time, maybe the margins need to be improved, or maybe it just is you're just spending a lot of effort trying to sell, and it's a difficult product to sell because there's something missing. And then again, lack of product market fit just means more risk for VCs. They're in the risk business, but if risk factors could be taken away, that's great. And again, and I think it's important. I'm talking about different areas companies can go wrong. No startup is always up and to the right. I think it's important to articulate especially if you're raising like a bridge or a second bridge or whatever it may be, why is now different? What is this million the million that's going to change things, or are we kicking the can down the road? And then I guess the final thing just to talk about on this slide is it really just isn't about runway, but it's about runway relative to what you do with it. So if you raise $1 million, and with that $1 million in a matter of 18 months, you've like 5x the value of the business, that's money well spent. But if you raise $1 million and at the end of the day, the business 12 months goes by, 24 months or 36 months, let's say you really just hang on to that, you hoard the cash, you don't really invest, and then the business is kind of worth the same all that time later, that's obviously not good. So we also, in addition to the Excel exercise we help companies build, we also try to help companies talk through what the business will look like, what that means for future fundraisers. So this is really important. Maybe the most important, I guess, lesson or thing I talk through out of anything that we talk through today. And it's very difficult as a founder, especially a first-time founder. You've never managed a board before or have investors around the table. It's really important not to fall into that pressure of putting a plan in place that even you as the founder who knows everything about the business inside and out if you don't believe it's even remotely possible. If you don't think you're actually going to do it, but nonetheless, you get a request, show me a plan that says this. You put it together and you hope maybe they know better than you. And then you end up in a trap where you misplan, you execute on it. It required you to burn more money, make some key investments. You run out of cash quicker than you thought because things didn't quite come into fruition, probably like you originally thought. Now you have to raise money again. Do you present when you're raising money, do you present a plan that's now worse after an investor's kind of been not burned, but that you've misplanned before? So it's important to make sure your expectations are lofty, because you're in the growth business as a startup founder, but also actually realistic. So in other words, a company a model should help you actually make decisions. It shouldn't just be this exercise of this kind of never-ending loop of missing plan, asking for more money, presenting it to an aggressive plan again, getting money based on that plan, missing that plan again, so on and so on. You'll just lose faith of everyone. So it's better to just be upfront about it, about what you think is possible. So again, a model should answer a few questions. When are we going to run out of money? The unit economics that we talked about before. Are we turning $1 into $3 or $1 into 50 cents? And over what time horizon? It needs to be realistic. What's working, what's not working. You need to be able to do scenarios and things like that. So again, I guess I spoke to this on the title slide here. Again, but there's that nuanced, too conservative, you're a lifestyle business, too aggressive, you're out of touch with reality. And it's funny, the way we usually see this coming into fruition, there's this kind of Q4 conundrum where everyone just kind of the year is just starting out. You want to meet a certain milestone, either it's an ARR number or kind of as of December of a given year. And we just see Q4 for some reason being this miracle quarter for all companies, because it just seems far away, I think. And you kind of use that quarter to say, hey, look, all right, we'll get everything in place, but really I think the growth will happen in Q4. And it's possible, just be mindful of it when you're doing it, because it just is very common. And it's very possible to kind of just fall into that same, like, oh, yeah, well, I think we'll get there. That's like, forget it. That's like almost a year away. We'll get there, but just be mindful, make sure that, look at the numbers, look at what your team will look like at that point. Can you actually do that at that point? It's important for the model to follow the same chart of accounts, or at least be grouped directly from QuickBooks. So in other words, we don't like seeing models where QuickBooks says one thing and then the model is like a totally separate thing. And it's impossible as a user of the model to know what happened, what's going to happen. So it just needs to be together and just grouped the same. So generally, just for the way we group it is basically every company is G&A, general and administrative. Some of it's people, some of it is other stuff like rent or the different SaaS tools and whatever, I don't know, phones, like whatever kind of things. R&D, which is like your product and engineering. You have people, and then there are other things, right? And then same thing, sales and marketing. You have people, and then there are some other things, meals and entertainment, whatever it may be. To me, that's a very easy way to just group, especially for a SaaS company, very easy way to group things. And then you could look at layers like, all right, just how much of my overall expense is just the team. And you could just carve that out really easily doing this. How much is other stuff? And then you could look at it, drill down a little bit in these buckets. So I generally prefer doing that. Again, our template has that as well. Now, I think what I want to just do next, I'll spend about 5 minutes just going through a live demo, rather than doing this last session, given timing. I've taken a little bit longer here. And it's one and the same anyway. So I just want to show you guys what this thing looks like. Again, we're going to be sending this exact template to you guys afterwards. So we built this in a way where there's just a handful of steps that you have to follow to get the model done. One is you type in your company's name. This is I didn't check if this is real, but I'm calling it theinternet.com. Very 1992 of me. Next is you map your current P&L from QuickBooks if you have one. So you just go here. It shows you what to do in QuickBooks, what to run, and you literally just paste it in. You paste it in. And then in this column, you just type in what it is. So, total revenue. So this total income line, you just map it to revenue. There's a drop down, sales and marketing, whatever it is, direct, people. There's a couple different factors here, and you just go down the list and just make sure you choose everything correct. Choose everything and map it over, and this will end up mapping into the model. Go back to the quick start. Go to the balance sheet tab. Do the same thing here. Paste in your balance sheet from the beginning of 2020 through the last closed month that you have, which I'd imagine for most companies at this point is February, because March just ended. You'll probably have your March numbers within the next few days. And you kind of go through, is it cash? Is it accounts receivable? This is just telling the model what your real life numbers are. Then go back here. A couple things you need to do here just to make things tie. Tell the model when real life ends and projections begin. So you just go here, put that in February 2021. We already did that for you. Do a couple basic assumptions around your margins, around how quickly you collect cash from customers. Some companies it's immediate, right? If you're selling things online, if you're selling to large customers, it sometimes takes a lot longer than that. Payroll assumptions and things like that, very basic stuff. The next step is just payroll. You just type in your employees, your employees, the name, location, what bucket they're in. Is it G&A? Is it sales and marketing, research and development? When they started, it's like, I can zoom out, and just what their salary is. And that's really it. Everything else will just flow through automatically. You don't have to do anything else. And so I should say the template we're going to share is more for SaaS companies. If you're in e-commerce or some kind of different, maybe a marketplace, so let us know. We're creating a new template for that too. But SaaS we just did first. So what we did here is we basically made a template for you to put in your current clients and your pipeline. So you would just go through. What's the name of the company? Is it an enterprise or an SMB? And I see most of our SaaS companies kind of bucket things that way, but whatever, you can kind of use it however. Is it an existing client or is it somewhere in your pipeline? We have selections for you. It applies a factor. You type in what the MRR will be at the start, type in a date. If there's a phase 2 of it where it grows or shrinks or whatever, you could type that date in and you can punch in an end date for it. That's all you need to do. Everything flows through. It's just formulas. So just put in, and now what I say is if you're a SaaS company with like either that's pretty large or that has a small average contract value with customers and you have like thousands of customers, you could easily just say, like, call this all existing customers, right? And then just put in what it is. And then the rest could be from your pipeline. So you could do this however. The employee count the customer count doesn't matter so much. It's really the revenue. And then finally, after that, you put in your projected revenue based on things that are after your pipeline horizon. So I know for us as a company, really after, our pipeline today will tell us really what's going to happen now in Q2, but not really beyond that. We can get an idea from Q2. So we do recommend, kind of filling this in after that. So you choose the date you want to switch over to this, and I just punched in September. You can make it any date. You put your sales reps in here, who they are, put their names, what their quota is on a monthly basis between enterprise, and then just down here as well, where it's anything blue you could change. And there's more complicated ways to do this that are more automated, but I found for most early stage SaaS companies, this is more than complex enough. You can put in what amount of the target you've hit or that you think will actually be achieved. Churn rates, just average, you could type in just the average to kind of back into an employee count, not employee count, a client count, and then it all flows together. And so what ends up, and then the last thing you do is on the income statement tab, after you've mapped everything, go in, you say, okay, so this is actual numbers, but for the projected, you know what, I think it's a percentage of revenue. It's projected on a percentage of revenue basis. It's 15, or it's 20, whatever it is. Or actually, no, let's just take whatever it was last month and grow it by 10%. Well, that was nothing. So I'll grow it by 10%, and it'll just do that automatically. If you have more insight than that, you can just like, you know what, we're going to spend a lot of money in sales and marketing this month. It's going to be 50 grand. You just type that in, but just be careful to like bring this back down to, you know, what it was. So you could easily just overwrite some of this stuff, but we kind of built in some basic functions for you to increase things. Once you do this for each expense line, and then the people line is coming from the headcount tab, so there's nothing to do there. Then you kind of have a basic shell of a basic model here that has what's going to happen, what's going to happen in 2020 or what happened in 2020. It'll show you your historicals, 2021, 2022, also quarters, also the months, and you can kind of go through, and then just kind of some cool charts to show you about your business. So, just the headcount, projected cash balance, break even, right? If these don't intersect, you're losing money. Revenue, this is what I showed you guys in the slides before. Existing customers, pipeline, post-pipeline, which is the sales rep driven one, pipeline detail, of the blue and the red, this just drills down on that. Even how much of the pipeline is real, how much of that is based on closed things that just haven't started yet. We've signed the contract. How many of them you've sent the contract? How many have you sent a revised proposal or sent the first proposal? Whatever it is, we built a bunch of factors in just to even show you how realistic some of these things are. And so really, at a really high level, again, what we've tried to do with this is just make a really easy way to build a basic model. And again, every company's different. You're going to want to layer some complexity onto this because every company has some kind of special circumstance or a slightly different business model. And so that's obviously what Graphite helps with. But you can get started, kind of with this template. So I can kind of go back over quickly to the slides. And yeah, I mean, I think just the biggest thing here is just got to be careful in the model of making sure that it shows you when weird things are happening, and in your actuals too, right? If you have one business line kind of like a cash cow and then others that are losing money, it's just figure ways out to just demonstrate that and dig into. So we recommend kind of, if to the extent you're large enough for it to make sense, creating kind of product line levels or whatever it may be. And so that's really where the, kind of the end of the presentation here. So again, just to recap, build a model with you in mind first. You're the founder and CEO. It doesn't mean you know everything. I don't know everything either. But really try to be very thoughtful about the projections that you put in place. Try to make it realistic. Don't sandbag it. That's another thing the board will start realizing pretty quickly, like, okay, you're just putting low numbers to make yourself look better. But, it's a lot of it's just having that conversation relationship with your board and investors about those things. Again, make it map to your chart of accounts. Build it bottoms up, not that thing that I said before where the market is $50 zillion. We're just going to take a fraction of it each year. It doesn't work that way in real life. Only build things in that you can actually measure right? So for example, if you miss revenue in the model, the template that we're going to send you guys, you'll be able to see, okay, it's just because you're typing your pipeline into it. It's because this client just didn't close on time. And so you'll just know that this opportunity didn't close. That's the difference. That's what happened. Not just, well, it didn't happen. I don't really know. It doesn't, I've actually heard founders sometimes say where they don't have it before they get a good model in place. They look at their actual numbers. And I've seen them say, this doesn't feel like the business I'm running. These numbers don't make sense to me. And when you're not measuring against anything, you don't really have a model. You don't really understand what, you haven't thought through all the levers. I understand it because it's hard to know what's actually going to happen in real life in a thoughtful way, right? And for example, that company in particular, the way they wanted to project revenue was just punching in the number that they thought it was going to be with nothing driving from that. We changed that, obviously, but if you just type numbers in, that's kind of just what you hope is going to happen. It doesn't tell you what you need to do to make that happen. And again, if the numbers are bad, it's an exercise of, this isn't like a shaming exercise. It's just like, let's think about why. Let's figure it out. And another thing, I've especially last year, because we had certain businesses that it did well, that certain kind of types of companies did really well during kind of lockdown, whatever, for different reasons, consumer behavior. Also a hesitancy to double down too, because if the numbers are good, it's also lost opportunity if you don't do anything. So if things are really good, the unit economics are great, absolute product market fit, then it's just a function of finding the capital the working capital to deploy. And so that's good too. Yeah, so hopefully that was helpful. I know I think Karen Deep, I think we opened it for questions. And so with that, I'll stop sharing my screen and go back to questions here.
All right, thanks a lot, Paul. Just give me a second. I'm just starting my video. All right. Well, Paul, thanks a lot for that great workshop. I think it was very insightful, and I'm sure all the attendees got what they were really hoping for. So thank you so much for the great workshop. So for everybody in the attendees, whoever is attending the event, you can send in your questions through the chat feature or the Q&A feature. So please go ahead and send in your questions. Paul, we actually have a couple of questions that have come in. Let me just find the correct one. So quick questions being shown. Okay, so in the model being shown, where do you include subscription fees and their evolution over time?
Oh, sorry, say that again.
In the model that was shown, where do you include the subscription fees and their evolution over time?
Yeah, so basically what you could do is for existing customers, you could use kind of that phase 2 if you think you're going to upsell them, or you could just put that same customer in as a separate opportunity, and that could kind of be your upsell. In the projected, the stuff in the future, there's a kind of an annual or monthly churn function. You could just leverage that as kind of net churn. So if you're upselling at the same rate that companies are churning out, then it would just be 0. So that's kind of the best way to model it there. Hopefully that answers the question.
Okay, all right, thank you. So the next question is, what would you advise for CAC calculation?
Yeah, so for this one, if you're talking about for SaaS, you're going to need to put in your entire sales team and everything like that. But separate from the model, for CAC, what I would do is for a SaaS company, if you only have, it's funny, we get really complicated sometimes when I'm speaking to companies and I say, well, how many people are on your sales team? And they're like, 2. Okay, so for those 2 people, let's just see what they've closed over time. Literally, what does it cost the company cumulatively over time for that person? What have they closed? I think that'll tell you more than even trying to back into what CAC is. CAC could be really tricky with SaaS companies when there's kind of like chunky, large contracts that close periodically. So doing it on that kind of in that visual way, I find is way, way easier. So I would just do, and I think we're going to show a recording of this or share the slides or whatever. So I just do it in that same way I went through in the slides. It's like a very first step.
Okay. All right. Thank you. So actually, the second part of the question came in later. So this question was actually supposed to be for an e-commerce company. So if anything changes accordingly.
Yeah, no, then it changes a lot to completely different. So so for an e-commerce company, it's really tricky, and this is where we find companies that they trip up because there isn't an easy way to do attribution. There's tools, but coming up with a consistent just attribution methodology, and by attribution I just mean if a new customer buys something on your website or app or whatever for the first time ever, just being able to attribute where they came from to begin with. We find companies, the tricky thing sometimes is if someone saw you in some kind of PR piece or whatever, and just like later came back just after thinking about you, it's really hard to figure out how much of that organic is driven just from like word of mouth versus like other efforts you're doing that just there isn't like a pixel to track what's happened. So have an attribution methodology. And then it really just comes down to, on the CAC side for e-commerce companies, how much did you spend in a given month? And from paid, once you've attributed all, just how many new customers that have been customers for the first time ever that month, not repeat customers. So what you've spent this month versus what you've, all the new people that have come in is the way to do it. And I think the one important piece to layer on top of that is it's depending on your subscription, on your model, right? We have some e-commerce companies that are kind of one-time purchases. Some are subscription, and some are kind of a hybrid where it's kind of like, it's just a product that lends itself to people buying it again and again, but not necessarily subscription. So depending on your model will depend on, so what we like to do is figure out what the economics are, and that should then inform you what your customer acquisition cost should be at a maximum given your risk tolerance, right? So let's say your first order profitable. So on average, let's say you sell something for $50. Your average card is like $50, 50% margin. So $25 gross profit on that order. And then on average, your customer acquisition cost is $25. So it's zero now, but if you're, and that's completely fine. If your reorder or engagement is really great after that, that's incredible economics actually, right? But if it's a one-time, something someone will buy one time ever, then that's obviously not good. So it depends on your product basically. So that's how to calculate it, but also how we think about what to do with that information.
Correct. Okay, I completely agree with you as well. So will this model translate well to a service-only organization though?
Yes.
Okay.
Yeah, so this is pretty similar to actually what just I use to run Graphite, to be honest. It's very similar. Ours is more customized, and it kind of tells us, given certain demand levels, what does the supply need to be in the future. So like there's a lot you can layer on to these, but I didn't want to like boil the ocean with a template and make it so complex that no one will know how to use it. So like, and I recommend doing that, by the way. But like to start, I think it's nice to just be able to put some things in, see what it looks like, then start having those conversations about what to do next.
All right. Well, thanks for that, Paul. So the next question is for DTC or e-commerce companies. How do you project out LTV for much, much later in life? Do you use a sophisticated curve or some basic assumptions?
Yeah, so it depends on it depends how much data you're working with. But what we find is, one of the first companies that I was part of at FF Venture Capital was Plated, a company called Plated, which was one of the bigger meal delivery companies. And that's really kind of where I started learning quite a bit about just retention curves and things like that. And basically what we found is, there's usually a bigger drop off at the beginning. And we see this consistently with our e-commerce companies. There's a drop off, but then that curve lessens. And then eventually you get to a point where we basically call it terminal retention, where it never dips much below a certain level. Like that dip, that churn each month decreases substantially over time. So when you're talking about really far out, we just try to come up with what's a reasonable, based on data you have and based on industry data, what's a reasonable terminal retention rate that's going to basically be in perpetuity.
Right. And so as a VC, what was the most important piece or pieces of a startup's financial model when you were considering them for an investment? And what did you put a lot of weight
on? So at the seed stage, it was more just that they were thinking about the business model, right? Especially if it's pre-revenue, thinking about how this is going to work, demonstrating how it's going to work. You know, a lot of it was just about the conversation with what's going to happen next. Or when you're pre-revenue, there's a reason for that. That means you're building the product still. So there's not much data to work with. So it's really just the thinking around it is, to me, was like, okay, these founders have really thought this through. And what they're saying today probably won't be happening in a year when they launch the business, launch kind of the revenue side of the business. But at least it gives me a lot of comfort that they've thought a lot of it through, at least. And then for A and B, because we were a seed stage fund, but we did quite a few follow on. That's when it was a little bit more, we were digging deeper into unit economics. What has happened? What's going to happen? Is it realistic? Is this company just, one of the biggest things, again, I said this very briefly during the session, but you know, is this, especially for like a bridge round, and that's usually often for a company that just hasn't gotten to the point where the milestones to get to that next level. Really, it was just a function. It was really just us thinking, like, is this gonna happen? Like, what's actually changing now? Is this, like, why are these numbers now? Why are things getting better today? Why is this million the million that makes the business start going up and to the right? Like, or is this kicking the can down the road? I'd rather, and like, we still back the company. Like, just want to have the conversation. Like, let's think through what changes we need to make, not just like hope it gets better.
Well, thank you, Paul. Thanks a lot. I think for any upcoming questions, we will try to share them via email with you. So it's about the end of the workshop, and I think this is great. For everybody in the audience, there will be a feedback form in the chat that will be pasted by the Graphite team. So please go ahead and just a second. So please go ahead and fill in that feedback form as well. Your insights are very valuable to us, and of course, improving the entirety of the event and the workshop as well. So thanks a lot for joining in. And for everybody right now, I would just like to get your attention towards the screen. We are hosting a Graphite Financial Venture Capital panel on April 20th from 11 a.m. to 12:30 p.m. EDT. We have a great panel followed by some high growth startup pitches. So please, we would love to invite you there, and we would love to host you there as well. So please go ahead and join us on the 20th of April. Well, Paul, thank you so much for this, and thank you so much for the great session, and you and Josh, of course. Well, for now, I hope everybody who was attending, received, whatever insights they were really looking for, and this was as insightful and valuable to them as well. So I hope everybody had fun as much as we did bringing it to them. So thank you so much for joining in. Thank you so much, Paul, and thank you everybody for joining in today. And until next time, please stay safe and take care.
Thanks for joining, everyone.